Congratulations on taking the step to learn more about trading options and becoming a true professional. In this video, I will reveal every detail about how I took 12,000 into 466,000 in less than 7 hours. Before we begin, make sure that you have checked your email. Make sure that you have found the file that looks like this, the PDF file. Make sure that you have taken the time, at least 10-20 minutes, to go through the questions and answer some of the questions in that file. Okay, so the 5 core principles, the 5 core foundational principles on what took place that day. I'm going to state them briefly, and then we're going to look into detail of every aspect out of the 5. Number 1, the reaction. Please understand that your opinion is absolutely irrelevant in the market. Whether the company announces great news or not is absolutely irrelevant to the relation of whether the stock price is going to go higher or lower. So we don't make predictions. We trade out of probabilities and we trade market reactions. Have you ever had a situation where you thought it was a great company, was about to announce great earnings, and you were right? The earnings were 100% wonderful. The earnings per share growth was astronomical. The sales numbers were astronomically higher. But to your surprise, what did you find out? Well, the stock dropped like a rock. Now, have you ever been in a situation where you expected the company to announce really bad news, and it certainly did, and the stock, instead of dropping, actually rallied, it went higher? Well, for that reason, I don't want you to be making any personal assumptions about what the news could mean to the direction of a particular stock or the market in general, because my opinion, your opinion as an individual trader is 100% absolutely irrelevant. In other words, you could be right about everything and the stock could go completely the opposite way, and you're going to be sitting scratching your head wondering what the heck just happened. So if you want to avoid situations like that, then don't make assumptions, don't make predictions. Just simply wait for the market or the stock to react to the particular news or data that is about to come out. In other words, don't buy stocks, don't buy calls, don't buy puts, don't do anything until you clearly observe the reaction of the market to the particular news or information, until you clearly observe the reaction of the market to particular news in a particular stock. Point number 2, trend versus TRO. What is a TRO? It's a trend reversal opportunity. Most of the fortunes created by top traders in the world throughout history, those fortunes were created utilizing trend reversal opportunities. In other words, a lot of times you guys will hear that trend is your friend and so on. Okay, trend is your friend. If you want to make some returns here and there, that's fine. If you want to create a fortune, you need to be paying more attention to a phenomena that I identify as TRO. In other words, when the trend has a high probability of reversing. And there's 2 types of cases: when the market or the stock particularly have been going higher and higher and it's about to reverse and completely reverse its trend and go lower. And the other possibility of a TRO is when the stock's been falling for a long time and it's about to reverse and start going higher. Concept number 3 is timing. Timing is everything. You can have the right stock, the right idea, you can even have the right trend that works in your favor. You could have everything going your way, but if you're wrong on timing when it comes with options, because with options, unlike stocks, we're always fighting the timing. So I have created, observing the markets over the last 12 years, I have created a proprietary formula that actually has patent pending right now. I call it 13 market moves. In other words, it's just like playing chess. The market can throw your way about 13 moves. And indeed, there's a few more variations than 13. However, the basic ones, there's 13 market moves, such as market going higher and keep going higher for the day, market gaps lower and goes lower for the day, and additional 11 variations of market moves. If you understand the importance here is not just being able to identify which market move is taking place, but rather than observing the probability of a sequence of a particular market move following another market move. And some very basic but crucial things. If you get the timing right, of course, that is 99% of everything. But trade size, cost of entry in relation to the opportunity. I see many traders that trade options that get in risking a few $1,000s just to make a 10-15% return on investment. My strategy is not based on that. As a matter of fact, I will never ever get into a trading opportunity if my returns on trading options are only going to be 10-15%. I will not even get into a trade if my returns are going to be 50%. I'm only targeting moves that will generate results north of 200%. More often, I target market moves and stock moves that will produce, as far as options, 300 to 400% return. So those are the 5 things. Now let's take a closer look. And please make sure you have a pen and paper handy as we're going through this material, because I don't have a ton of slides and I'm going to be explaining a lot of details. And please make sure, if you want to make the best out of this interactive video, that you take notes as we go along and you identify some of the key points and write them down. The 13 questions. Number 1 question that was emailed to you. What are some of the common things that you noticed between the stocks that were traded that day? Well, let's take a closer look. What are some of the stocks that were traded that day? Well, clearly, you got stocks like Amazon, Google, Priceline, Tesla, and towards the end of the day, I actually bought a large position in VIX, the volatility. And typical answer I hear to that question, well, hey, they're all technology stocks. Yes, that is an important observation. Why is that an important observation? Please take note of that. The markets overall were going higher. Like S&P 500 was going higher that day. Dow Jones was going higher. But in particular, NASDAQ was going lower. Now, interestingly, at the same time, NASDAQ decided to go lower as Amazon that day opened at around $10,010. Google was opening over $1,000 that day. Coincidentally, on that day, both of these key stocks were reaching for their 52-week highs on that day. Now, the importance of this is, number 1, the trend, okay? I particularly picked this group of stocks, yes, because they were technology stocks. But then your question may be, well, why didn't you just pick one stock? And I'll get into that in just a second. So number 1, yes, they're all technology stocks. And the importance of that, overall, NASDAQ was falling. So the overall trend of the market was for the technology stocks to fall. In other words, I was not having a situation where Google was going higher, Amazon was going lower, Priceline was going higher, Tesla was going lower. They were unanimously going lower that day. So the trend was clear. The trend was apparent. The group, the sector was apparent. But to answer that question, what are some of the other things that these stocks have in common? Well, the number 1 thing, do you see any stocks on this list that trade under $350? No. So very important to understand this. Please write this down. I don't trade stocks or options on stocks under $100. Now, occasionally I will make an exception where I'll trade options on a stock that's $65, $75, but overall, I tend to stay completely away from cheap stocks. If you want to trade cheap stocks, sure, trade penny stocks. I know a lot of guys that do a great job at that. Now, since we're talking about options, the very advantage of trading option is the leverage that it offers you. And I don't mean leverage as far as, borrowing money on margin to trade options. As a matter of fact, I never use leverage to trade options. I only use the capital that I have in the account. So there's no dangers of, borrowing extra money on margin here. What I mean by leverage is you can actually get into the big player arena along with a bunch of institutional investors that trades the stocks that typically an individual investor is not going to be able to trade. Stocks that trade for $1,000, $2,000 like Amazon, Google, and Priceline and so on. Now, the importance of this, why do we not trade cheap stocks? Well, imagine this. Let's go for an example here. You've got a $10 stock. If the stock moves 3%, which is typically a pretty large move if the stock moves 3% on an average day, right? How much is the price of that stock going to change? From 10, it may go to 10.30 or it may go to 9.70. That's simply not a large enough move to be profitable in trading weekly option. Okay, so I don't trade cheap stocks. So please write this down. Be very selective of the stocks you trade. What is the one common thing? Yes, they were technology stocks. Number two, they were all pricey stocks. The importance of dealing in pricey stocks is this. If Google trades around $1,000, a 3% change in the price of that stock is going to produce a $30 move, which creates enough of opportunity for me to profit. Now, what is important to understand, we'll get into that a little bit later, is the daily trading range. Write this down, DTR, or daily trading range. In other words, in Google, that could move 3% on the day. It could actually move, if we combine the overall move for the day, in other words, Google could open higher $20 in the morning, and then it could close that positive gap, all right, and then it could go lower by another 30. So we're looking at the daily trading range now of $50, which creates insane opportunity for trading weekly option. Okay, so those are the things, and these are the most important things to understand, that not all stocks are going to be very good products for trading weekly options. So with that, I'd like to spend a little bit of time and explain to you the importance of a watch list. If you're starting out, or maybe you've been trading for a while, look, you got to have a very solid watch list. Look, on my watch list, guys, I got about 300 stocks that I follow every day, and I keep adding stocks. I keep taking stocks away. I have a very good watch list. In other words, I want my merchandise. I want my products that I'm trading. I want them to be the right products. And by the way, let me make a point about this, that not every $1,000 stock is going to make a good product for trading options either. We're looking for high volatility stocks. And what I mean by high volatility stocks, well, if you simply take a look at the graph, okay, some $1,000 stocks might have been trading in the range from $9.90 to $1,010 for the entire year. In other words, they've never had a historically a large move on the upside or downside. So that would not be a good product. But if you have a high volatile stock that trades at $100 plus, then you want your watch list to be comprised of such products if you're buying and selling calls and puts. Now, another importance of creating such a watch list is this. Now, I talk to a lot of traders on a daily basis, and sometimes I hear, well, I have my watch list in alphabetical order. Guys, let me state this to you, okay? It would drive me absolutely nuts and insane if I had my watch list in alphabetical order, okay? I'm not trying to get organized here. I'm trying to get a temperature of what sectors are doing in what type of fashion every morning. In other words, if I open my watch list, okay, instead of watching for CNBC or, listening to some analysts, this is my news channel. My watch list is my news channel. I go to my watch list to understand how a particular sector is doing after market closes, after or before the market opens in the morning. For example, if I open my watch list, I will have simultaneously 30, technology stocks right next to each other. And if I open my watch list and all 30 of them are in the green, what does that tell me? That the market trend for technology stocks overall is up today. So I'm not going to just go and short a bunch of technology stocks. If I open my watch list and I see all my biotechnology stocks, which I have maybe 50 in a row, right next to each other, if all of them are in the red, this is a good indication. Look, my strategies, my 5 core fundamental system is based on increasing your probability of being correct in the market. Okay, you're not going to be nailing every trade no matter how hard you try. But if I help you increase your probability, I promise you, you will be able to do much better. And that is our goal. So if you can take anything, the point number one is make sure you got the right products and make sure you have a very solid watch list. Watch list is key. And so far I've mentioned, technology stocks. I've mentioned biotechnology stocks. Those are good stocks. Why do you think they're good stocks? Just take a moment and answer that question to yourself. Well, because we're looking for high volatility stocks, right? So it's the high volatility stocks that make us money when buying and selling options. Stocks like, for example, Intel or Microsoft that only move maybe $1 or maybe a couple of bucks on their best day are not good products for trading options. Some of these low volatility stocks like Coke, it's a good product for selling options. But that's not what we're doing. This video is not about you holding a bunch of shares of a particular company and selling out of the money options, hoping that the stock is never going to move to that level and collecting the premium. It's a good strategy, but this is not what this video is about, okay? This video is about trading options on high volatility stocks. So watch list, use this as your news channel. For example, I have all my Chinese stocks on my watch list, 30 or 40 of them in one specific area of my watch list. So if I open my watch list in the morning at 6:30 and I see all of my Chinese stocks are in the red, well, apparently there's something going on in China. There's some announcement that took place, okay, where the entire sector is reacting. So that is a good information to have before you start trading that day. Okay, let's move on to some other important details here. How was the initial capital allocated during the beginning of the day? All right, let's go here and let's take a closer look. Okay, so clearly in the morning there is a transfer, as you can see, for $12,000. This is what I start the day with, okay? Then I'm faced with a decision, okay? Look, I'm trying to set a record that day. I've done some calculations that lead me up to believe that I'm going to have a good trading day that I have planned for. By the way, I don't do this type of trading every day. I have been planning that day for close to 2 weeks to actually waiting for Google and Amazon to try to hit their all-time highs. And when they were not breaking higher, when I noticed the low volume, that was the trigger for me to start placing my trades. And we'll talk a little bit more about that in just a second. But so I'm faced with a decision. The point I'm trying to make here, guys, is this, okay? This is not all or nothing type situation, okay? I could have easily just invested $12,000 into a particular trade, but I do not recommend that you ever allocate your entire trading capital into just one single stock. As a matter of fact, if we review this, this is the ideal situation for me, about 3 or 4 stocks. Okay, but in the beginning of the day, the question is, how did I allocate my capital? Well, clearly, I've initiated the position in Amazon. As you can see here, I bought 50 contracts of Amazon, 997.5 puts. And at that point, I believe Amazon was trading around, 1,008. So I was buying them about 10, maybe $11, $12 out of the money. And so that's why I was able to get such a good price. Now, I was able to buy 50 at 62 cents. And some of you that are trading right now in the markets, you guys are going to be like, whoa, how'd you get it so cheap? Well, if you remember, and actually let me give you an answer to one other question. What was the day on which these trades were taking place? It was on June 9th, 2017. Clearly, recently, starting with February, March 2018, we have an environment where the VIX, your volatility index, is in the range of 20, 30. I mean, back then, the volatility index was around 10. So options were priced quite a bit less. And some of you are also wondering, okay, well, what type of day was it? It was actually one of the questions in your email. What day was it, and what was the importance of the day? The importance of the day was the options were expiring that day. It was a Friday. So I was trading options that were expiring that day on Friday. Okay, and so that is how I was able to get some of these options ridiculously cheap. Again, my strategy is what? I'm not seeking these opportunities where I'm making 10, 15%. I'm seeking opportunities where I'm making 3, 4, 5, 600%. In some instances, I'm able to lock in 800 to 1,000, 1,200% gains. So let's take a look at the first trade. So I'm buying Amazon, 50 contracts at 62 cents. The cost of that is $3,145. Now notice this very important factor here. Shortly, maybe 20 minutes, 30 minutes later, I sell 25 of them at 3.9. So same question. You're going to be wondering, well, hold on, why aren't you selling all 50 at 3.9? Because I never sell my entire position at the same time. See, some of you may be faced with this dilemma. Well, how do I know, when is the right time for me to sell my stock if I'm making money? Guys, write this answer down. You will never know 100% the ideal timing when it is ideal for you to close your position. So what do? You split your position. The answer is simple, okay? Every time I open a position, immediately I go in and I split my position. I'm going to show you here in the first two examples, okay? So the first 50 contracts I bought for 0.62 cents, I immediately sell a closeout order on these on half of the position to be closed out at 3.9. And this is exactly what happens literally 20, 30 minutes later. So I sell half of the position. I was buying these contracts at 0.62. I was selling them for 3.9. That is roughly 650% gain in less than 30 minutes. Okay, now notice what happens later. I don't have that highlighted, but I actually end up buying, and I end up selling more Amazon. If you study this PDF file, I end up selling more Amazon. See, here's another 25 contracts. I end up selling them at 5.9. So, and this is what I typically do, right? I set half of my order to be executed at 3.9, then I set half of the order to be executed at 5.9. And please, don't misunderstand. I don't mean that every time I enter a position, those are the numbers I set. No. Again, the strategy is I'm looking for 3, 4, 500% gain. I don't know, in some instances, I may be experiencing a 300% gain. I don't know at that point if the stock is actually going to move further in my favor. So I'm not going to double guess. I'm not going to sit here and wait, oh, I hope it's going to go much more lower and make me more money. No, I'm going to clock half of my gains right there and then. And if the stock keeps going my direction, guess what? Later in the day, just like it shows right here, I'm going to be able to sell the other half of the position at a much higher amount. Now, your question is probably like, okay, well, Leonardo, okay, fine. Why didn't you just wait? And why didn't you just sell all of them at 5.9? That would have been 1,000% gain, actually like 900 and some change. So why didn't you just do that? Well, again, because you don't know when the stock exactly is going to turn around and start going against you. Okay, you will never be able, I don't care how many years you trade, you will never be able to ideally identify that perfect moment each and every time. In some instances, you may be able to. But so, my strategy here, and guys, if you faced this difficulty in the past, okay, as you notice, I never buy just one contract, because if I buy just one contract, I don't get the luxury to do that. So, my minimum position would be 2 contracts. If the trade starts going my way, what I do is I sell one and I keep the other one for further gains. Now, you're going to ask me, well, okay, I get that, but why not just sell all of them? Well, the idea is if I sell one, I'm automatically locking gains. So let's say the position starts going against me. Okay, if the position starts going against me, I'm going to end up selling the other half of the position. I'm going to make less money. But at this point, I'm in a situation where I am guaranteed to not take a loss. And so if I can control that, then certainly I'm guaranteed by the end of the day to end up with a profit. So sell half of the position, let the other half run. If you notice it starts going against you, lock the gains at whatever they are at that point and move to your next trade. Okay, so in this example, I have shown you specifically, okay, that I bought my position, how much I paid for it, how much in gains I have actually had. So the first trade was 650% gain. The other half of the position was closed at a 920% gain. The way we got into this conversation, okay, is the question in your email was, okay, how did you initially split the capital? Okay, the point I was trying to make, I did not just go out and I did not just buy one particular stock. I didn't just go all out on one stock. I split the capital between 2 stocks. One of them was Priceline, which is now trading under a different ticker symbol and still a great product to be trading options on. BKNG is the new ticker for Priceline now. But initially, as you can see, I bought 4, then I bought 56 more contracts, and I bought 2 more contracts. And as you can see, I bought 4 at a cost of 145, I bought 56 at a cost of 140, and I bought 2 more at a cost of 150. So for a total of 62 contracts. Okay, now notice again, I'm trying to make a point here, guys, ladies, gentlemen, okay? Pay extra close attention to this. I am buying 62 contracts. I'm setting half of the position to be sold at a certain amount. So there you go. Half of the 62, roughly 30 contracts, I'm selling them at 5.9 for a gain of 390%. Now look what happens next. See these 32 contracts? I've had my limit order set at 7.8 to liquidate the rest of the position. Okay, so at this point, I have made 2 trades. The account went from 12,000 to 52,000. That's not counting the rest of the 25 contracts of Amazon, which was sold right here and brought the account to 69. Okay, now so far I hope you guys are following me, and the most important fact out of this is you open the position. When it starts going your way, you take half of the position out, you let the other half of the position run. I don't set ever any stop losses. This is a very common question. Hey, Leonardo, do you set trailing stop loss of any kind? No, I don't do that. Okay, if I'm trading, I'm in front of my computer, and this is how I trade these weekly options, because sometimes, depending on what market move you have, things could move very, very fast, and I want to be able to, switch my position. I want to be able to switch my limit order right there and then. But as soon as I open my position, I go in and I set a limit order at 2 or 3 different prices at which I'm going to automatically liquidate my position when it starts going my way. So hopefully, very important lesson learned right here. And by the way, I do use the same strategy at times when I am trying to build a position, when I'm trying to scale in. I may initiate a position of 30 contracts at such and such price. I may wait 10 more minutes to see what direction it's going, and then I may add another 30 contracts. To emphasize it one more time, I never put the entire capital in any one given position. I try to split it. Now, there is a fine point between completely diversifying, as you probably hear everywhere, especially, from a bunch of different stock pickers. Hey, you want to diversify, you want to get into 20, 30 different stocks. Look, I wouldn't be able to make it to the next day if I had 20, 30 positions that I was trying to monitor at the same time. Okay, it's not humanly possible, not to me. So maybe some other stock pickers are doing that. I would go totally nuts if I had to monitor 20 positions at the same time. So I never have one. I never have 20. My point here is I don't want to be over diversified to where I am not managing the position correctly. And that's exactly what's going to happen. If you use this diversification philosophy, you're going to end up being stuck with too many positions. And when it's going to be a perfect time to get out of the position, you're going to miss that. When it's going to be a perfect time to get into a position in another stock, you're going to be able to also possibly miss that. So it's going to be very tough to manage. Now, who is actually recommending that you diversify? Well, it's big institutional funds, okay, because they invest in billions and billions of dollars into this stock, so they have no choice but to be diversified. But also think about the kind of returns these guys are targeting. Look, if they're making 15% annual return, they're like a rock star, okay? Think about the returns that we're trying to focus. The idea here is to commit a small amount of capital that will be able to produce a large return. Again, how much capital did I commit to this Amazon trade? 50 contracts at 62 cents. It was a total investment of $3,100, which was lately taken out at an average profit between 650 and 900%. In other words, 750%. So that initial investment of $3,000 was turned into into a profit of close to $25,000. Within 30 minutes, guys, okay? So let's talk a little bit about the importance of what day was I trading, okay? The importance of which day, and that was another question in your email. The day was Friday. Friday is the day when these weekly options expire. Now, do I trade every Friday? No, absolutely not. Why do I trade on certain Fridays? Well, again, because I have this proprietary formula of market moves that I have developed. Okay? I seek only to trade on days on which I understand what is actually taking place in the marketplace. Okay, in other words, there's going to be some tricky moves that the market is going to do on certain days, which are going to be very complex for this type of trading. And so in order to avoid those days, it's important to understand the 13 market moves. And I'm not going to be able to explain all of them in this video, but I will point out this, that on that particular day, it was market move number 2. And so please put yourself in a situation if you know exactly what all of these 13 market moves are. And if you know that in certain cases, certain market moves have a probability of repeating themselves in a sequence to the extent of 70-80% probability, then this is how I identify on which Fridays do I actually trade. So is every day going to be a move number 2? No, but there is a certain sequence that help me figure out the probability of what type of market move is actually going to take place. And so some sequences will provide you with a probability of 30%. Of course, that's a lot riskier than a 70 or 80% probability. So I try to only seek out opportunities on Fridays where I know which market move is going to take place with a 70 or 80% probability. So to help you understand, market move number 2 is when market actually gaps up higher and it tries to go higher. Please pay attention. Very important distinction here. First 45 minutes of the day, between 9:30 and 10:15. You'll hear a lot of traders say, hey, this is where I make the most of the money. My opinion on these guys is, hey, this is where you lose most of the money. Maybe not on stocks, but we're talking about trading options. And when the market opens up, typically at 9:30 in the morning, your options are going to be priced with a premium, with a significant premium. In other words, when the market gapped up higher, how do you think that impacted the call options premiums, especially when the market started going higher that day on June 9th? Well, of course, gap up higher, that's a very bullish signal, okay? So a lot of guys decided to jump in and buy a bunch of calls, and they paid a lot of money for them. Just to find out at around 10:15, the market started turning around. And this is roughly when I started opening my position. So the key takeaway here is what? Number 1, know your market move. Number 2, you're much better off staying out of the market between 9:30 and 10:15. Unless you're keeping your positions overnight, and then there's certain market moves that have a sequence that I have discovered that will actually cause the market to gap lower the following day. So in this case, you would be opening your position the day before with a 78% probability of the market gapping lower the following morning. Now, this is not the case that we're considering here, okay? We're dealing only with the trades that were placed. There was no overnight trades gapped this day. So I did not place any trades the first 30 minutes. And you're going to say, well, didn't that take extra 30, 40 minutes out of your trading? Well, sure it did, okay? But it gave me a perfect entry point, okay? Just you have to be a contrarian when you are dealing with TROs and what I identify again as trend reversal opportunities. So what is the most important thing here? When the market goes higher, what does that do to the price of put options? Think about it for a second. Well, put options, they would go lower, right? The price of put option would go lower. So on Friday, you're able to literally, if this is a market number 2, when the stock market opens in the first 30 minutes, the stock market goes higher. When everybody thinks that the market is actually going higher, you're able to buy these put options at ridiculous levels. You saw in my example how I bought 50 Amazon put options for just 62 cents a piece. And when the trend reverses, again, TRO, trend reversal opportunity is exactly what we're trying to target here. When the trend reversed and the market started going lower, it became apparent to everyone that the market is not going higher that day. And what did that do to the price of your put options. That's right. They appreciated in value very, very rapidly. Now you're going to ask me, okay, Leonardo, okay, fine, okay, but how did you know that the market was going to do this? How did you know it was going to go higher and then going to go lower? Again, if you want to be successful in the stock market, you have to be a student of the market. You have to observe. Guys, I look at what's happening with the markets after the market closes. I look at what's happening with the market before the market opens. I look at what's happening in the overseas markets. I look at what's happening with the currency markets. I look at what's happening with the commodity markets, because all of those things are interrelated and connected. But the main criteria, just to help you out, okay, there's two main things, okay, two main things to look out. Look, I'm not going to share 100 indicators. And to be honest with you guys, ladies, you don't need 100 indicators to be a successful trader. As a matter of fact, you don't need to know 50 different, chart patterns to be successful. All you need is 3 chart patterns that are going to make you a very successful trader. I'm going to share them with you in just a few minutes. Okay, but for the purpose of demonstrating this market move number 2, the reason I knew that the market had a very low probability of moving higher, as all the analysts were actually pitching everybody on CNBC that, oh my God, Google is breaking out higher. It's gonna break out today. It's at the highest level it has ever traded. Amazon is going to break out higher. It's going to the moon. When you hear analysts starting as bullish as the general public was on Bitcoin in December 2017, look, those are the kind of signs that you got to look out, because when everybody gets overly optimistic, but at the same time, and what actually taking place is you see these really good stocks that do have a good case to go higher, but they actually barely get in there on very low volume. So write this down. Low volume, as the stock reaches for its all-time high on very low volume. That is actually a bearish indicator. What happens to VIX? Okay, let's say VIX around June's been at an average of 10, 11. Okay, what was happening that day? All of a sudden, when these technology stocks started reversing by about 10, 15 that morning, what do you think happened to the VIX? Well, naturally, the VIX actually, surprisingly, before even the market reversed clearly by 10, 15, the VIX was starting to go higher. And it's not like it jumped, guys, from 10, 11 to like 15. Nothing like what you've recently observed in the markets, probably, where the VIX jumped from 14 to 20 to 30, 44. Nothing like that. But what I'm saying is, typically when the market heads higher, the VIX should be going lower, even by a little bit, right? Well, in this case, I was noting that the VIX was actually going slightly higher, maybe from like 1040 to like 1060 sort of thing. Not a big move, but at the same time, it communicates a case of a possible divergency developing. What do I mean by divergency? And please write this down. Divergency is a very important aspect that I observe when it comes to relative strength indicators and some other things. But in this particular case, the VIX, the volatility index, which was supposed to go lower as the market was going higher, it actually went a little bit higher. And the volume was very low. So as all the analysts were pitching the idea how Google and Amazon were going to break out of their all-time highs and go even higher, the volume was telling me a completely different picture. So far I've showed you a couple of the trades that I placed in the morning. Now you notice that when these put options, I was buying them really cheaply right here. I closed them out, some around here, some around here. What did I do? I actually waited for the market to bounce a little bit higher. Now, what do I mean by that? Well, just know this. Please write this down. The markets never go down in straight line. Okay? Never do the markets go up in straight line. You will always see a situation where they will go lower, move higher, lower, higher, and so on. So when the market moved higher, I was able to initiate same positions at different cost of entry, okay, but same positions. When the market moved lower, I used the same strategy. Close half of my position, close the other half lower. When the market bounced higher, I opened the put positions again and closed them. And See, a very important question in your email is this: how did the size of my positions change throughout the day? And what was the importance of that? Well, and I get a lot of answers like, well, dude, you made money. So, naturally you just went ahead and you put a lot more money so you can make more money. No, that's the wrong answer. The reason I have significantly increased my positions, because every time the market did this, it went higher, then it went lower, it went high, it became more apparent to me that this was going to be the trend that was going to be prevalent throughout the rest of the day. That was going to be the trend that was going to dominate the markets that day. So it's precisely knowing initially in the day, observing the volume, observing the VIX, shorting the stocks, basically through put options that everybody was so bullish and optimistic in, caused me to be able to significantly decrease the cost of entry and therefore show a significant profit. Now, if you are brand new, this is what would probably happen, as it did happen to a lot of investors and traders that day. As the market gaps higher, that's a bullish signal. You buy a bunch of calls because the VIX is low, the markets look positive, the analysts are bullish, everything is wonderful. So you buy calls right here. When the market reverses, you're like, oh crap, what just happened? So you're going to sell your calls at a loss. Then you're going to get in and you're going to buy puts right here when it becomes clearly apparent to you that, oh, well, the market looks like it's going to fall. And what happens as soon as you buy those put options here? They go against you. You can only tolerate the pain for so long. You end up closing your puts right here. And you're like, man, no, I was right. The market sure was going to go higher today. So you get in your position right here. You buy calls again. Just to find out that the market is going to go lower. So by this time, you would have taken 3 losses and you would have completely been wiped out. So how do you avoid that? It's understanding the sequence of the market moves. And again, I have a proprietary system I have developed. There's about 13 of them. Guys, you don't have to be a rocket scientist. I promise you, you can learn this. It's very easy, and you're going to be able to execute on an entirely different level. Okay, what are the characteristics, okay, of this particular market move and strategy? Right here in the notes, you're going to see a suggested and recommended strategy, okay? So typically, this market move will start with a gap higher, but shortly, volume will fade and will start reversing lower. VIX will first go lower, but shortly will start spiking higher. The strategy is called short at the top. In other words, you don't want to be shorting at the lower level. You want to be shorting the stocks for put options as the stocks are actually going higher, which may be counterintuitive to a lot of you, but this is exactly what you got to do. And if you're afraid to click the button and buy put options when the stock prices are going higher, guess what? You're just going to have to make yourself do it. And after you do a few successful trades, you won't have no more issues with doing it from that point on. Okay. Now, as the market opens higher in the morning, the put options become very inexpensive. Use this as an opportunity to get great bargains on put options. This strategy will start producing huge returns as fast as the market reverses and becomes clear to everyone that the market will not go higher. So that's a quick summary of what we've talked about. And this pertains to the part of our 5 core fundamental principles here is timing. A lot of people say, well, you can't time the markets. You can't do. You know what? I agree. Nobody's going to be able to time the market 100%. No one. But understanding the sequence, understanding the 13 market moves. It's just like in chess. If you ever played chess, there's like a certain number of combinations that you would expect your opponent to make after you make your move. So if you can calculate all these moves in advance, you can be more positioned for a win and increase your probability of knowing what would be your next move if the market was to make a certain move against you. Okay, so knowing and understanding this definitely helps you increase your chances with timing. Not 100%, but it definitely increases your probabilities. Let's talk about a couple other questions. What was happening in the market that day? Okay, well, as clearly you would think that if you go back here, and you analyze, all of my trades, if you didn't see what the market was doing that day, you would have probably been thinking, oh my God, there was a crash of some kind. Okay, well, as you know, there was no crash in June of 2017, yet you see a 3,800% gain. The point I'm trying to make here is the markets do not have to crash for you to be significantly profitable with put options. So please write this down. The market does not have to crash for you to be profitable with put options. As a matter of fact, it could actually make it a little bit more difficult, because when it becomes apparent to everyone that the market is crashing, what do you think happens to the cost of your put options? Well, they go much higher, right? So it's going to be a little bit more difficult when the trend is apparent to everyone, okay, to be able to produce returns of 5, 6, 7, 800%. So these trades were placed in a typical market environment, and that is the idea of that question is, look, nothing needs to be crashing. As a matter of fact, S&P 500 was positive on the day. Dow Jones was positive in that day on June 9th, and yet I was buying a ton of put options. Now notice, not only did I buy put options, I also bought a number of call options that day, which were also profitable trades. So I was playing the market on both sides of the equation. So if you'd like to learn more about how to do that, I will show you a couple more tricks, okay? So the cost of entry is very, very important, and we'll talk about that in a minute. What was the average percentage return of the trades? I think we've talked quite a bit about that, anywhere from 390 to 800-900%. How much did the underlying stock went down or up that day in percentage and absolute value? I think that is a very important question, so let's talk about that for just a second. The daily trading range, again, earlier I had you guys, ladies, write this term down, DTR, daily trading range. Daily trading range on Amazon that day was trading probably as high as, $1,112. And it hit a low of the day for just a brief second of like $950, and it bounced super, super quick back to 960, 970, 980 range. So overall, the stocks, as you can see, they were not crashing. They did have a slightly higher move than you typically would expect from them. So, 3% move would be $30 overall. In the event of Amazon, it moved, $60 roughly. So maybe a 5 to 6% move in some of these stocks. All right. Now, I hope you will be able to draw some of the conclusions and write this down after we're finished with the video. All right, we've talked about the importance of a solid watch list and being able to read it as and view it as a TV channel. Let's talk a little bit more about the trading strategy, okay, which is a core fundamental number 2, seeking out TRO. Again, TRO stands for trend reversal opportunities. And you can do that as on individual stocks as well as on market indexes, such as, trading the SPYs and so on. Okay, so key characteristics, again, we're observing the VIX, we're observing the volume, and the key trend that prevails the market right now is the prevalent trend over the last 9-10 years been, well, the market goes down, buy the dip, okay? And this is still sort of in place right now, but that psychology in the next year is going to be obsolete. And what people are going to be doing, they're going to be shorting the tops and they're going to be selling the rips. And so in just a minute, I'm going to show you specifically the patterns, the chart patterns that will help you identify those opportunities that are going to be applicable not just to weekly options trading, but let's say if you consider trading weekly options being a little bit too hectic for you, being a little bit too stressful, being a little bit too demanding, okay? Maybe you still have a full-time job that you're working on or something like that. Then maybe a longer-term strategy that is based on these core fundamental principles as well would work for you a little bit better. And some of these patterns, they develop over the course of a few months. So when you put in this longer-term option strategy, you would be actually looking at maybe buying an option with an intent of keeping it for a couple of months, and you could also go as much as a year. So in other words, if you got identified a stock out there that's trading at $600 that has a very good probability of going down to 400 in the next 6 months, this could be a very, very easygoing, nice trade without causing you a lot of stress and a lot of daily trading. Okay. Now, the process. This is the process. I scan daily the macro environment. What's going on in the world? What's going on, internationally? What's going on in the overseas markets? What's going on with the Trump administration? What's going on with tariffs? What's going on with the dollar? What's going on with the gold? What's going on basically with some big issues that could impact the market overall. Then I take a look at individual stock charts of the stocks that I'm trying to target. Then I look at the charts for the indexes, typically the S&P, typically the Dow and the NASDAQ. Okay, I focus on identifying clearly the trend and the sustainability of the trend and any signs that could be pointed out to a trend reversal opportunity, which is the type of situation, again, that's going to produce the largest amounts of gains for you. I spent some time specifically analyzing where the big institutional investors are placing their money, because I certainly don't want to end up on the wrong side of the equation. I don't want to be betting against these big guys. So I get some institutional data, not just observing the increase of volume on particular stocks that this big shot, big money is placing their bets on, but I also get specific data, subscription services totaling maybe a few $1,000 a month, guys. All right, that I get some data that tells me about what options they're buying. And when I say a few $1,000, I don't mean like I probably have 7 or 8 different subscriptions, and I don't use any one of them as one sole indicator of what's going to take place, but I do study them and I do make my own conclusions about what the market is, where it's headed, where it's going, what stocks are going to be to my advantage to put on my watch list. Time in the entry and the exit, I spend a lot of time identifying that, and the cost of entry. Let me talk a little bit about the cost of entry. The cost of entry is crucial because sometimes a difference when you're trading weekly options of 5 minutes, sometimes a difference of 2 minutes can make a profound difference. Because, for example, if I'm buying, Amazon put option for $3 and 3 minutes later it's worth $4.50. Which, for those of you that may not be trading options, let me actually just break that down. If the option is worth $3, okay, you're actually spending $300 because it controls 100 shares. If you're, buying the same option 3 minutes later, and then instead of $300, if the value of it is $450, now you're spending $450. Okay, so there's a difference of the cost there of $150 per contract. Now, that is not the most dangerous part. The most dangerous part of the cost of entry, if your cost of entry is too high, and maybe some of you guys that have been trading for some time, maybe you've been in a situation where you're like, oh, the stock is dropping, you're trying to get in, and you just keep chasing it, and maybe you're putting the order in, and it just doesn't get executed, and then you got to basically wait, and by the time you actually end up getting the position, maybe you started trying to get into it at $4, and now you ended up getting into it at $8, and let me ask you what typically happens after that. Yes, exactly. The stock reverses and it starts going higher, and you lose money. Okay, so the point I'm trying to make here is actually 2 points. Point number 1, do not chase stocks. Again, the entire strategy here is you want to buy put options when the stocks are going higher, not when they are apparently falling and it is obvious to everyone, because at that point the cost of put options is going to be extremely high. Number 2, if I'm buying the option at 3 and you're buying it at 450, okay, and let's say I'm targeting a quick daily trade that will produce a 200% return. So I would, in my case, automatically set a exit point when it hits $6. So I buy it for 3, I sell it for 6. In other words, I invest $300, I sell it back for 600. Would you be able to do that if you're buying it at 4.5 or $450? See, if you bought it at 4.5, by the time it actually trades at 6, you're nowhere close to doubling your money. In your case, the value of the option would have to go all the way up to $9 or $900 for you to have that 200% gainer. So the most important thing is knowing about the cost of entry. If you chase the stock, if you chase the put option, more often than not, you're not going to be able to set a very profitable exit point, which is going to eat into your profits, which is going to actually undermine this whole philosophy of where you enter only trades that generate high returns of 300-400% and so on. So see, if I'm now targeting a 300% gain, I'm in at 3, I can get out at 9 with a 300% gain. If you got in at 4.5, at 9, there's no way you can get the 300% gain. You're only gaining, another $450 there, or 200% return. Okay, so hopefully that makes sense. Now, that's not actually the end of it. The worst thing that can happen is when you're chasing it and you're buying it and you're trying to set that limit order to hopefully even get a lower percentage gain, and instead of going your way, that trade starts to completely reverse. And instead of making any kind of money, you end up clocking a loss. So the cost of entry is crucial. Again, do not buy put options on the way lower, because you're going to end up paying too high of a premium. So please write that down. Buy put options when stock prices go higher. It's the same thing. Look, if I was to draw a parallel with call options, right? They say buy low, sell high, right? Well, when the stock goes lower, and it's from the standpoint of a trend reversal opportunity, TRO, when the stock bottoms, okay, everybody still thinks, oh, it's a loser. It keeps going down. It keeps hitting its 52-week lows or whatnot, right? So nobody thinks it actually has a high capacity to change the direction. A good example of that would be Netflix. Years ago, it fell from $300 all the way to $60. The stock has been so badly bitten up, and so the call options were just ridiculously cheap. Okay, I remember Carl Icahn coming out and saying, hey, I've got me a 10% stake in a company. So overnight, those shares jumped from $60 to $80. Well, the options that were worth literally $80 calls when it was trading at $60, they were worth 10 cents. And by the end of the next day, when the stock actually ended up going all the way to $88, $89, those call options were worth like $13. So you had a 10-cent call turn into a $13 call. In other words, for every $10 you would have invested, you would have gotten $1,300 back. Now that's the power of trend reversal opportunities. So buy calls when stocks are actually about to reverse. And this is a totally different subject. I cannot be discussing all the details here. How do I identify those opportunities? For those of you that want to learn more, you will certainly have an opportunity to do so. Specifically, what do I look at? Again, I analyze the macro environment daily for identifying possible future trends that could impact the stocks on the watch list. I analyze the chart. I don't look at a bunch of different crazy things on the chart, but what I do look at is volume, relative strength index, and I look for cases of a divergence, which I'm going to give you a very good example in just a minute here. But basically, I am looking for a situation when the stock price action is not matched by the action in these indicators, such as volume and RSI and accumulation distribution. In other words, when the stock price is going higher, but the volume is going lower, the relative strength of the stock is going lower, the accumulation is going lower. Those are three cases of a divergence, which means as stock price going higher, the indicators are pointing out to a totally different thing. And this is about the time where you got to start paying really close attention to what's about to take place. And this is about the time when things could start to change direction. In other words, their trend reversal opportunity. And that's what I do. I use the signs of trend change and analyzing stock past to present behavior and compare it to the sector group and market trend. I spend some time timing the entry and exit points, establishing in advance at which level I'm getting out, and establishing in advance what is my max tolerable loss. Cost of entry could make or break the trade, and we just spent quite a bit of time talking about that. Ladies and gentlemen, I'm going to give you 3 patterns. Now, there's hundreds of patterns out there that you could be studying. I'm going to give you the 3 that I have used on this trading day, taking 12K to 466. Not only that, those are the top 3 patterns that I believe, in my view, are most predictive of what's about to take place. And particularly, the whole idea here is to target trend reversal opportunities. So those 3 patterns are a good indication, in my view, that a trend reversal could be taking place in the near future. All right, what are they? Short the top. And when I'm talking about shorting the top, clearly you've heard, most of you probably heard about the double top. Now, sometimes double tops, they will actually turn into triple tops, quadruple tops, and what I would call any variation of a multiple top. Now, the important thing to understand about shorting the top is, in the case of a double top, the stock can retrace back slightly and make another run or a third attempt, if you will, to try to take that highest level out and move higher from there. The more times the stock is actually attempting to break to a new high, the higher the probability that it will fail. So I absolutely love these opportunities that are not necessarily a double top, but I like those opportunities that are a triple top or a variation of some kind of this multiple top. Now, head and shoulders. Now, some people are saying, well, I've used the head and shoulders and I haven't had any results. Well, head and shoulders, actually, you have to fully understand what and how the head and shoulders pattern actually is properly formed. So there's some head and shoulders that you could look at. They're going to look like a head and shoulder, which are not going to be a real head and shoulder. So I'm going to show you an example of a good head and shoulder in just a second. And the third type of pattern is what I call a loss of momentum. Loss of momentum is applicable to really good stock. And if you watch some of my YouTube stuff, okay, then I often talk about how good stocks fall as well. So the loss of momentum would be, a good example of that would be, over the years, was a GoPro, right? GoPro. All of a sudden, ticker symbol GPRO, opens up at 30 bucks, during the IPO, goes to 40, 50. Everybody thinks how crazy, everybody starts shorting it. To make the long story short, the stock within months trades at $98. I shorted it at 90, and so after I shorted it at 90, it actually moved against me $8, and then within a couple of weeks after that, fell to 80, 70, and so on, and now it trades at $5. So the loss of momentum, you're going to have some stocks that are going to act in a ridiculous and unexplainable manner. Another example of that would be Tesla. Makes no money, has tons of debt, tons of issues, yet the stock keeps climbing higher. Go figure it out, right? So, but at some point, all of those stocks, like GoPro, like Tesla, they lose their momentum. Now, don't expect Tesla to lose its momentum tomorrow, okay? Sometimes this loss of momentum, you really got to time it and target it and be prepared to take action when action is needing to be taken. Now, there's a combination of data that you could identify to help you trade the loss of momentum. A good example would have been when recently Netflix traded from 300 after the earnings announcement all the way to 338. I have noticed some unusual options activity, that there was a $4.5 million bet from institutional investors actually betting against Netflix after it just skyrocketed from 300 to 338. I noticed another bet for 1.5 million shares in options. And interestingly, they were all short-term options that were betting that the stock basically was not going to go higher than 338, because they were all 330 dollar put option. So I've observed some of this. I've looked at the graph, and I've identified that this could be an indication that the stock is going to lose the momentum. Otherwise, why would they be committing $6 million on such a short time frame? Because, see, typically institutional investors, they can come in and they can hedge against the stock falling because they could be uncertain about the earnings announcement. But what was interesting about that options trade is that options trade came after it announced positive earnings, after the stock rocketed another 10-15% higher, and that's when the bearish trade came into play. So observing some of those things could really help you on top of the 13 market moves, since we're now talking about it, particularly in individual stocks, could really help you nail some of these timing factors, which will help you be profitable. Now, speaking of the result of that trade, within 8 days, Netflix dropped from $338 to $292. That would have produced a return of 1,200%, depending on when you would have entered the trade. Okay, so loss of momentum. Great stocks, been going up higher, higher, higher for a long time. At some point, they just fade. They lose the momentum. A good indication of that would be, again, as the stock is trying to go higher on lower volume, especially if you have a situation where it's paired up with multiple top formation. In particular case with Netflix, it was previously, maybe a month before that, trading at a range of 330, 333. It barely went $5 higher than that on lower volume. It was just a perfect short opportunity. Okay, take a closer look. Try to answer some of these questions as we're going along here. Okay, so what do we have here? We have AutoZone, ticker symbol AZO. And the question I want to ask you, observing this graph, do you buy or do you sell? And of course, if you can answer that question, then you'd be able to answer the question, well, do you buy options? And do you buy calls or do you buy puts? Okay, so observing this graph, take a closer look. This is the stock price right here, $708. It was just at $740. Do you buy or do you sell? Just answer that question to yourself real quick. Okay, let's find out the answer. And that is February 23rd. As you can see in the previous graph, we were right here. So after that, the stock actually has moved to almost 800 level. So the correct answer, observing this graph, do you think the stock would have moved higher or lower? The answer was higher, so you would have been buying call options. Now, how did I know about this? Well, there's clear some chart patterns and indicators you can observe. Here's a bullish crossover right here with a 50-day moving average line crosses the 200-day moving average line. When that cross is made, a lot of institutional investors are paying attention to that because the more recent price action indicates a bullish trend. So this is typically about the time where they would be coming in and scooping up a bunch of stocks. Okay. Also, if we look at the accumulation distribution right here, it's got a very positive upward trend. If we look at the MACD indicator, the black line is above the orange line, which is also a bullish indicator. If we observe the volume, a lot of these higher candles, they are actually on days where the stock moves higher. So lots of buying volume we're observing as far as the volume concerned. Also, the RSI is in a very positive territory. It's not always sold where it's at 90, okay, but it is trading at about 60, 70 range, which is bullish as well. So observing some of these things, I've just been able to identify 5, 6 different bullish things that would point out to a move higher. And so that's exactly what takes place here. Now you can see when we're talking about this positive crossover, right? So the stock actually trended sideways for a little bit and then it took off, reached this level of 800 and so on. Now, let me ask you a question. Looking at these graphs, how about now? Buy or sell? Just give yourself an answer. Just shout it out loud. Buy or sell AutoZone here? Okay. Hopefully you've gotten that answer right. Let's check it out. All right, boom, this is what happens. So the stock from this point right here, it drops. Okay, and I'm going to clearly identify and show you the head and shoulders pattern, which was one of my top 3 patterns that I like to observe. And also for those of you that intend to be more like a longer term investors, traders, This is a very good pattern. It works, I would say, in 70, 80, 90% instances sometimes. And, you can definitely, if you identify the right head and shoulders pattern, if it's the real head and shoulders, you can really, really lock in some really strong gains. Now, for those of you guys, ladies, that are trading daily, weekly, a lot of these patterns there are and can be observed on daily charts, weekly charts, so you can still use them and apply them. But from the standpoint of longer term trend, they carry a much greater value because, as you can see here, the head and shoulders pattern has been developed from December all the way through March. So it's a few months. It's a very well developed pattern. Let's take a closer look exactly what makes me call it a head and shoulder. Okay, here's what we've got. And I'm also going to go over a few cases of a divergence which I observed before this crazy move of $70 lower took place. Okay, so here's our left shoulder of the graph. Left shoulder of the graph in a head and shoulder pattern would typically be characterized by a much larger volume in the left shoulder. Okay, and this is exactly where I'm pointing at right now. This is exactly what we're observing. When we move into the head part of the head and shoulders formation, you will notice here, as it says here, stock goes higher on lower volume. See these little things right here? The volume dries out. So the volume was higher here in the left shoulder. As the stock proceeds to the head part of the pattern, the volume dries out. And again, this is very consistent with my overall just a couple of key indicators that I use, which is the VIX and the volume. Okay, if the stock moves higher on lower volume, this is a bearish indication. Then we get to the right shoulder. Okay, and in the right shoulder, in relation to the volume observed in the left shoulder, you will see a definitely much lower volume in the right shoulder. In other words, there's no more buyers here. There's a lot more sellers. And clearly, if you observe these red candles, they're sort of more prevalent here. And so we're observing a lot more selling than we're observing buying. When the stock was trading here, there's clear signs of a divergence. Notice right here, the stock was trading at a $740 level. Look at where the relative strength for the stock was, RSI. It was in a range of, in this point, it was at the highest point, it was at 70. Notice as the stock price goes higher, what happens to the strength? The strength of the stock actually goes lower. So now we sort of started this downward pattern. Notice where the relative strength index now that the stock is trading back at the same level of 740. It is literally half of what the relative strength index was right here. Now, all of these things are correlated. The lower volume, the relative strength index, okay, they're correlated. So now we're getting the divergence, okay? The stock goes higher, the volume goes lower. The stock goes higher, the relative strength of the stock goes lower, all right? So I'm observing these key divergences. Also, observe that on the MACD. And just know that when the black line crosses the orange line, this is actually a very bearish sign. And clearly, if you would have used this as an indication, when the black line crossed the orange line right here, this was a bullish sign. The stock took off from here to here. Now we're observing the reverse of that, and so the stock falls from here to here. So far, we've gotten a few bearish signs of divergence in volume, the RSI. We clearly identified a true head and shoulders pattern here. And now let's take a look at the accumulation distribution, because the next question is this: what do you think the stock is going to do from here? Do you think it's going to jump higher? Do you think it's going to continue to fall lower? What do you think is actually going to take place from this point on? And so me observing this accumulation distribution, in other words, as the stock dropped right here on this day, which by the way was after the earnings, so it was trading at 735. The next day it was trading at 650, and it closed at 659. So that drop right there of $70, $80, you could have bought the options, the 690 puts, for literally $4, and you could have sold them at the end of the day for around $48, all in one day. But as you can see, there's a lot of studying that goes into identifying some of these patterns, and you're not going to be able to time them exactly on which day, but on that particular day it was quite easy to time it because Look, one of my rules is I never buy options before earnings. I always buy them after the earnings. And I'm going to go into a few details of why I do that. But in this case, this move was very easily identifiable because, as you can see, the stock after the earnings did not drop right away. It actually started, it opened up at about $710. So you still had plenty of time, I'd say within the first 15 minutes of the market open, to buy this stock puts. And eventually after that, it still fell $60 lower. Okay, now again, back to the accumulation distribution. What do we see? Well, we see that a lot of people that could have sold the stock, they have not sold it yet, which means, in my view, the stock has a much lower move yet to come. Okay, so what happens? Let's take a look to see what happens. This is a different type of chart, but shows you how it falls from 650 all the way to 610. As a matter of fact, the couple of days before that, AutoZone was trading as low as 590, 592, and it sort of bounced from there. Some of the key things that I want to bring to your attention: the importance of the watch list. For example, in my watch list, I would have AutoZone, I would have O'Reilly, I would have some other, parts retailers on my watch list. So what would be the importance of that? Advanced auto parts. So I'd have AAP, ORLY, which is O'Reilly, and I would have AZO, which is AutoZone, right next to each other. Well, it comes very handy to notice if one of those stocks, because they're so correlated, if one of those stocks starts falling, then you could expect one of the other stocks to pick up the momentum and proceed in the same direction. So in this particular case, we've got an incredible trade reversal opportunity. In other words, O'Reilly reported great earnings. So from 590, 600 range, AutoZone jumps that morning. It opens up at 640, proceeds to go higher to 650. Now remember, this is not a monthly chart, guys. This is actually a daily chart. So all of this took place within a few hours. So as you can see, 9:45 it trades at 640. At 11 o'clock, it trades at 650. At 12 o'clock, it trades at 615. This is a $35 move. Now remember, in consistency with our trade reversal opportunity strategy, okay, when the stock jumps higher and goes higher, what happens to the price of your puts? They become ridiculously cheap because O'Reilly just reported great earnings. But we don't know yet if AutoZone is going to report great earnings. It has not reported earnings yet. But yet, the price action in O'Reilly has a very positive impact on AutoZone. So if you didn't know that O'Reilly reported earnings that morning, you might have been thinking, well, what's going on with AutoZone? Why is it going higher? I don't get this. There's no news. Well, it didn't need any news for the AutoZone company itself. It just needed some news from its competition. And this is how sometimes institutional investors measure the probability of a competitor also announcing good earnings. In other words, you might have noticed when some of the FANG stocks, Facebook, Amazon, Google, and so on, when they report good earnings, sometimes in after hours or pre-market, you would see the other FANG stocks spike as well if one of the FANG stocks announces really good earnings. Okay, so perfect trend reversal opportunities. These 640 weekly options, they were worth about $1 a piece when it was going higher to 650. By 12 o'clock, they were worth $25. Now, that is a return of 2,500%. You're going to ask me, Leonardo, man, that sounds pretty good. What are some of the other examples you could give me of a good watch list during the earnings time, right? That I could maybe lock in another 2,500% gain. Well, as you know, Expedia is a competitor of Priceline. And every 3 months, Expedia will actually report earnings exactly roughly about 2 weeks before Priceline does. And you would typically see no news on Priceline, but because whether Expedia reports great earnings or not, it will significantly impact Priceline, or what is now BKNG. And in the event, let's say Expedia falls 5-10%, then you would expect a fall of sometimes $50 to $100 in the stock price of Priceline. BKNG. So the opposite is true if Expedia goes higher, as it did this time. It went from 108 to 117. So did Priceline, went roughly, $50, $60 higher. Now, in some instances, the move in Priceline is going to match the move in Expedia. In some instances, it's going to be a little bit lower. But every 3 months, that correlation is strictly observed. So if you simply plan on that, that is one easy trade that you can always get under your belt. All right, so again, trend reversal opportunity is what we are targeting here. Okay, rules. I've talked about how you got to have some certain rules set in place. And I'll just give you an example of a couple of the rules that I follow. Okay, I absolutely buy no options before earnings. Why? You hear a lot of guys talking about, earnings strategy, and the truth is, yeah, you can do all kinds of crazy strategies. You can do butterflies and spreads and all kinds of crazy stuff out there. The truth is, most of these, option trading strategies, they're only going to cut into your profit. You're looking to actually significantly diminish your returns if you try to implement a lot of those strategies. Those strategies are good at certain market environments. Again, we're trying to target certain market environments that are good for our strategy. As far as trading options before earnings, there's a couple of things that is a definite 100% probability is you're going to pay too much for the option. So how does that relate to our philosophy of the cost of entry? I spent quite a bit of time talking in this video about the importance, the cost of entry, and how it could ruin your chances of successfully getting out of the trade or potentially experiencing a complete loss as the result of improper cost of entry. So the options before earnings dictate a very high premium. So if you buy them before earnings, you're paying too much. Okay, again, the strategy in our options trade is not to pay too much for the option. As in the opposite, we're trying to find bargains where we're paying too little for the option and then selling it too high, whether it be a call option or a put option. Okay, so that's point number one. We don't buy options before earnings because they're too high. You're not getting a deal. Now, the next day after the company announced earnings, these options take a significant depreciation. I actually could be right about the direction of the stock and I could still lose money. You're going to say, well, what do you mean? If the stock is going higher and you buy call options, you can still lose money? Absolutely. This is not gambling. This is not a casino. We're talking here about increasing your probabilities of being correct more often than not. When you are buying an option at a high price and is guaranteed to depreciate significantly the following day, then you're putting yourself at a very low probability. And a lot of people that have ever been to a casino may be thinking of this as, when you're at a roulette table, if you're betting a black or red, it is a 50% probability. Well, actually, it's not. A lot of people completely disregard the fact that if the ball is rolled at the roulette table, there's also a probability of hitting a 0 or a double 0. What happens if you bet on black or red and a 0 comes up? Well, you lose. So it's not a 50% probability. How does that apply into trading options? Well, you're thinking the stock is going to go up. Somebody else is thinking the stock is going to go down. What if the stock does not go anywhere? What if it opens at about the same price as it was trading yesterday? Then the bulls are going to get slaughtered. The bears are going to get slaughtered. And so in that case, you may say, well, then some option strategy is definitely going to be used because I'm going to be able to profit on both sides of the equation. Yeah, but you're not going to make much. You're not going to make a 400, 500, 800%. And also keep in mind that your probability at that point is less than 30%. Okay? In other words, you're not going to make as much if bulls prevail or if bears prevail. You would only make with certain strategies, certain option strategies, if the stock stays at the same price. Okay, so you're really just cutting into your profits by exercising some of those strategies. Okay, so I don't buy options before earnings because it is too much of a gamble. I want a better case scenario. I want a higher probability entry point. I want a lower cost of entry. That is what helps me become more profitable as my trading day proceeds if I understand the market moves, if I have a good cost of entry, if I execute these trades the way I'm supposed to, if I'm not chasing the trades, then I am definitely going to have a higher probability of a win rather than a loss. So if I don't buy options right before earnings, then when do I buy them? Well, I buy them specifically after the company has reported their earnings and I have been able to observe the market reaction to the earnings. Remember, the one core foundational principle of my strategy is I watch the market reaction first. So I'll let the company report the earnings. I observe the market reaction because, again, it could be a good company reporting great earnings. It could fall. So I don't want to be caught on the right side of the equation. So observe what the market reaction is. At that point, I'm also able to observe whether a particular stock has any probability of a TRO or trend reversal opportunity. At that point, the options are significantly lower priced than they were the day before. I know the direction of where the stock is going to be headed. All these factors make for a higher probability entry. Now, but this is an entire different video, and specifically how do I target the trend reversal opportunities in stocks during their earnings announcement. At this point, I've done my best to reveal as many of my secrets as possible in an hour and a half of this video presentation. I hope that you have taken some really good notes and you will be able to apply some of this knowledge. If you're ready to beat the market at the game of chess, take action now. Here are the tools that you will need. Here are the tools you will need to take your trading options skill to an entirely new level. There's 4 products here. Option Alert subscription, where you will be delivered specific option trading ideas that are based on our proprietary formulas. On top of that, you will have an opportunity to subscribe to institutional option alerts, where we compile data of many institutional investors placing unusual options activity trades during real life market conditions, and sometimes simply by following the same trades that they're implemented, you will be able to catch some really nice profitable trades. This particular option does not involve any personal one-on-one interaction. So if you have some specific questions, about anything relating to trading options, definitely schedule your one-on-one coaching session by clicking and getting some more information on how you can do that right here. If you're looking for the extreme value that combines the option trading ideas and some one-on-one interaction on daily basis, we offer a 13 market move subscription, which is daily interaction of 15 minutes a day with an options trading coach who will guide you and explain you specifically what the 13 market moves are, how to specifically place your trades based on knowing those moves. And more importantly, as many traders that I talk to daily, sometimes they just wish they knew the days when they should have just completely stayed out of the market. Can you think of it this way? Think about 90% of the bad trades you have ever placed. If you could have just simply eliminated them, you would be highly profitable, wouldn't you? Well, this is specifically what the 13 Market Moves subscription allows you to do. It goes over daily trade and idea generation. It goes over the institutions' plays in their daily trades. It goes into a lot of various factors that allow you to profit from this proprietary 13 Market Moves formula, which helps you identify on which days to trade and take action, and on which days to just stay away. 30-day training bootcamp is laser focused on chart secrets, how to read the secrets of trading between the lines, pattern recognition, how to see them before they actually appear, trading idea generation, where to find most profitable trading ideas each week, and of course our proprietary 13 market moves, how to trade market reactions and strike with a profitable move at the right time. It is not a webinar with 100 people in it. It is actually one-on-one training and coaching. So if you're ready to take your game to the entirely new level, simply subscribe to the tools you need right below this video and make 2018 your most profitable year ever.